Good morning, everyone. We got people dropping in by the minute here, by the second. So good morning to everybody. Hopefully everybody's doing super well today.
TGIF.
Which means nothing in real estate and mortgages. Our busiest days of the week are about to begin, Friday evening through Sunday night.
That's right. That's right. So
we can get started. Let's get some introductions out, let everybody know who we are, and let's get this show on the road.
Let's do this. Thank you everybody for joining our call today. I am Kayla Tyre. I'm the Jacksonville market leader for the Epic Mortgage team. We have online with us Kyle Baker, who's our Orlando market leader, Courtney Douglas, our Fort Lauderdale market leader, Jed Herman, who has been with Andrew Cady since day one building the Epic Mortgage team, and of course our fearless leader, Andrew Cady, branch manager and founder of the Epic Mortgage team, who will be speaking today. To tell you a little bit about Andrew, if not, some of you don't know much about him, some of you might, but he has been featured in the keynote address of Social Media Marketing World Conference and the Traffic and Conversion Summit as to who to watch on social media. He helped script and launch a social media campaign in 2019 for a multi-billion-dollar mortgage company. He is listed as the top 40 under 40 loan originators in the United States in 2020 to watch. He's a huge veteran advocate for the use of their entitlement that they sacrificed and worked so hard to earn. And in 2021, he accomplished over $107 million in production, and he's now bringing his skill set to help others grow and lead a team of top producers. He is an RE bar camp facilitator in Jacksonville and in Destin, and he's been for the last 5 years. When he's not working and building the Epic Mortgage team, he spends his time at home with his beautiful wife, 4 children, 2 dogs, a cat, and he loves the beach and loves to jet ski. He's the team dad to his daughter's volleyball team. And without further ado, I will let Andrew take over. Actually, housekeeping item. If you have questions during this presentation, please drop it in the chat. There's a question box, so please put your questions in there. At the end, we will address all of the questions and get them answered for you. So please put your questions in the chat throughout, and we will get those addressed at the end. And now, without further ado, I will let Andrew Cady do his presentation for you.
Thanks, Kayla. So yes, good morning, everyone. If you see me looking down every so often, I've got a dog. My dog is just standing right at my side right now, so she wants to be on this presentation. But yes, happy Friday, everybody. Just for me, like, I got into this industry because of my passion to help homeowners. And in 2020, I found myself, like so many other mortgage originators, just getting out there and reporting the news of what had happened and what is happening in our housing market. And it started to drive me a little insane because I felt like just an armchair captain. I felt like the guy that was just reporting what was happening, and I didn't even understand why. So I personally, in 2020, made it my mission to really understand our markets, to not just be the armchair reporter that says, here's what's happening, but I want to know why it's happening. I want to understand our mortgage-backed securities market. I want to understand in and out and what's going on. And so for the past 3 years of my life, I have really dived deep into housing market analytics. And if you follow me on social media, you see these things. But today I want to talk about the state of our housing market. So I'm going to dive into this presentation. We're going to go kind of deep into some analytics on these things. Some of this is going to be very in depth, but I do my best to try and bring this layman's terms as much as possible. So where I want to start with this whole presentation is I want to start with how the Fed impacts mortgage rates, because there's massive misconceptions out there every single day. People think, and loan officers and real estate agents and consumers think that because the Federal Reserve is raising the federal funds rate, that is why we have high mortgage rates. And in fact, it couldn't be more opposite. What you see here, this blue line that traces here, this is your mortgage rates. Or sorry, this is your inflation numbers. And down here, no, backwards, sorry. This one here is your inflation numbers, and this is your mortgage rates. And going back, I could have taken this chart way back. Traditionally, there's about 1.5% spread in between of these, and they kind of ebb and flow. And so mortgage rates are going to follow inflation. And if you think about it, it makes a ton of sense. If you're lending money out and you're collecting, say, $100 a month on that payment you're collecting for the money you've lent out, and inflation goes up 10% in a year, well, now your $100 payment is only buying $90 worth of goods. And if inflation goes up 10% the next year, well, now you're only buying $80 worth of goods. So the higher inflation goes, the higher that investors, the higher yield investors demand for investing in mortgage-backed securities, which drives up the cost of mortgages. And so what you can see here is we have this period where mortgage rates really didn't follow inflation. Inflation began to rise about July of 2021, and it really started to go up fast. And mortgage rates held their line and at this stupid low rate of low threes, high twos, and it held this for quite some time. So you say, why doesn't, in a situation like that, why didn't mortgage rates follow inflation? Well, there's this bar I put on here called QE period. It's a big term called quantitative easing. In layman's terms, that is the Federal Reserve. When the market messed up and really collapsed itself in 2020, the Federal Reserve came out and instituted quantitative easing. Basically, in layman's terms, they spent trillions, not billions, trillions of dollars on mortgage-backed securities and treasuries to artificially keep the economy going. So even though inflation was rising, mortgage rates stayed very, very steady. But the moment QE ended is when mortgage rates began to follow inflation once again, and again tracked themselves up above inflation. But if you see right here at the very end of this chart, we're starting to see inflation come down, and with it, mortgage rates are coming down. I know this hasn't been the greatest week in mortgage rates, and if you're not super up to date on it, it's been a really rough week on it. But as a whole, we're starting to see the tide turn. And I want to pull up the most recent CPI report. CPI stands for Consumer Price Index. This is the measurement of inflation. So you have two numbers to watch here. Up at the top is your headline number. Inflation's at 4.9%, which is actually a big gain down from where we've seen. This peaked out at almost 9%. So we're cutting this way down. But the core inflation reading, which is all items less food and energy, is right here sitting at 5.5%. This is the number we really need to watch. And the reason we're watching this number is because the Federal Reserve, they look at this number. This is the one they want to get to their target of 2%. And the Fed watches this number because they don't believe that their monetary policy impacts food and energy costs the same way it does everything else. And it makes sense. Food and energy costs can be driven by so many things, global things. You could have a storm in the Gulf of Mexico that takes out oil production for 2 months and drives oil prices up. You could have a drought that impacts crops. You could have a war in Ukraine, the breadbasket of the world, that impacts food prices. OPEC, like they did a few months ago, could just decide to raise the price of oil. So the Federal Reserve is watching this one particular item. The two highlighted items on here, I'm going to start with the bottom line, is shelter cost. And I'm going to dive a little deeper into this one on the next slide. But shelter cost is a real problem in the CPI report. Shelter cost is owner's equivalent rent and rent. And we all know in the real estate industry and the mortgage industry that rental costs have been going down, not up, for about the last 12 months. But there's a massive lag time in when this begins to show up in CPI. And if you've been following me for any amount of time, I've been talking extensively about May 10th being the day where we start to see shelter turn the corner, and shelter should drive down inflation. And we did. We saw shelter start to come down. If you start looking at these month-over-month numbers, in February, shelter increased 0.8%. In March, 0.6%. In April, 0.4%. But our party that we were supposed to have was really spoiled, and it was spoiled due to this wonderful thing called used cars, which is really insane to me. Used cars have been decreasing at a shockingly fast rate. Decreasing on a month-over-month basis, going back to October, 1.7% in a month, 2% in a month, decrease. And then in April, used cars jumped up 4.4% in a month. A massive increase. And it honestly has to be somewhat of a blip in the radar, because if you annualize that 4.4%, that means that used cars a year from now are going to cost 50% more than they are today. So we do think this is kind of an anomaly in the report that should correct itself on the next cycle. But here's why shelter is so important. Kind of breaking these numbers down. We went from 5% inflation to 4.9 on the headline, 5.6 to 5.5. These are the April numbers that came out on May 10th. The core reading came out with inflation increasing 0.41% in a month. Now, what's interesting is if used cars would have come out at 0, not even continuing their decrease, but just a flat line, the 0.41% would have been 0.27%. And if used cars would have continued their downward trend like we would have expected, this actually would have been 0.22%. So it would have cut the increase of inflation in half. But here's why shelter is such a big deal. Shelter makes up 43% of the total core CPI. So think about it in sense of a pizza. You have all these slices of pizza, but one piece of pizza is 43% of the entire pie. And when that is the one piece that keeps increasing, it's pushing all of the other numbers out of skew. But shelter has turned the corner, and I'm going to really break this one down. So these are our shelter costs. And if you want to know how an annual shelter cost is calculated, how the annual year-over-year increase in shelter is calculated, well, you take the month-over-month increases and you add them up for 12 months. So what happens is in March, we had a reading, what is that? I have to look closer, at a 0.56 reading, and that replaced a 0.50 reading from the previous year in the annual amount. Well, that means that shelter costs still went up again in March, fractionally, but went up. In April, we got this super great reading of 0.42% that replaced out a 0.50%. So shelter's begun to turn the corner and come down. Now, if we look at the trend line on this, February, call it a 0.8, March, call it a 0.6, April, call it a 0.4. If this trend line continues with May's report that'll come out in June with a 0.2, we're going to replace a 0.62 number for May of last year. That means our shelter costs could decrease on an annualized basis 0.4% in a single month. So the shelter turning the cost is going to drive interest rates down, and it's going to drive them down fast. But we have other dilemmas that have come into play on this thing. So we had this whole party scheduled. Trust me, we were all ready for it. But there's so many outside factors that begin to play into mortgage rates. And one of the biggest issues right now is the bank deposit dilemma. We all know Signature Bank, Silicon Valley Bank, First Republic Bank have all failed. These are massive, massive failures. Those three banks combined are about 90% of the total value of failures that happened in 2008. So these are not small banks that have failed. You see First Republic here, their stock's down 99% year to date. They're dead, they're gone. PacWest is another one. They're down almost 81% in the last 6 months. This is a massive, massive problem. So what's happening? Well, first and foremost, we're getting a run on deposits at these banks. So it's important to understand how the deposits work at a bank. So if you walk into a bank today and you deposit $100,000 with the bank, you walk in, give them 100 grand, they're required to keep between 5 to 10% of that money as liquid cash. For easy math, let's call it 10%. You deposit 100,000, they're going to set $10,000 aside as their liquidity requirements. And then from there, they're going to lend out that other 90,000. They may invest that into treasuries, mortgage-backed securities. They may take Johnny who walks in the bank and says, I want a car loan, and lend your 90,000 out to him. Well, it becomes a problem when the Fed has raised interest rates as fast as they have. There's options out there where you can go earn 4 or 5% on a money market account or a high yield savings account. And these banks are greedy. PacWest, last I looked, they're paying a 0.41% interest rate on your checking account. So people are beginning to look at this saying, wait, I've got $100,000 in the bank at PacWest, I'm making 0.41%, but if I just move that money to Synchrony Bank in their high yield savings, I'll make 4.25%. So they walk back into the bank and say, hey, I'd like my $100,000 back. I'm gonna move it here where I'm gonna make more money. Well, they've lent out 90,000 of it. So they give you the 10,000 that they've held in reserves, and then they take 10,000 other people's reserves and they give it to you. And that's not normally a problem until the stocks start falling and there starts to raise fear about a bank, and then everybody shows up and says, I want my money. Well, now the stock's tanking, so the bank can't raise capital. So what are they doing? They have to sell their holdings, their treasuries, their mortgage-backed securities that they've invested in, but they invested in when they were super low or super low yield, and now it's high yield. So now they're selling these off at a loss. And so the mortgage-backed security and treasury market's being flooded right now with banks trying to raise capital to simply handle what's going on in the markets. Another topic that I'll bring up that isn't really on this docket, but it's weighing a lot on the treasuries right now, which is impacting mortgage rates, is the debt ceiling crisis we're up against. I'm not going to dive into the politics of it. I'm not going to go into that side of it, but the insecurity of not knowing whether the United States is going to be able to pay its debts has our markets in jitters. And yesterday, super predominant investor Ray Dalio came out, spoke about it, and it really rocked the stock market, or the stock and bond market, which has caused a sell-off in mortgage-backed securities. So mortgage rates are on the rise again right now. And here's the reality: rates will come down. Inflation is the driver of this, but it's going to take time. So if rates are coming down, we know buyers, the moment rates come down, buyers are going to be back in the market. So where do we go from here? Inventory is going to be our issue. The chart you're looking at right here is new housing starts. New housing starts is a really important chart to watch because in America, we need about 1.46 million homes to be created simply to handle new household formations in America. But then you also need to add about 100,000 additional homes to that because of fire, flood, storm damage, and homes aging out. Homes need to be rebuilt after a certain period of time. So really, we need just under 1.6 million homes to be built in America to sustain. That's what this horizontal purple line is. That is where we should be. And it's interesting, if you pull this chart, it's on the Federal Reserve economic data, you can go all the way back to 1960. There's been periods of overbuilding and underbuilding, but they're typically a 6 month to 1 year period of overbuilding and underbuilding. But this line of about 1.45, 1.5 million homes has been a very steady line from the 60s on. But what happened here is we see nearly a decade of overbuilding leading up to the 2008 crash. And then we see a dozen years of underbuilding where we underbuilt inventory in this country. And this whole section right here, it's the largest blip on the radar when you extend this chart out. But this whole section right here comprises about 6.8 million single family homes short for current demand. Now, multifamily has stepped up in a massive way and has filled about 4 million of that gap, but we are still, according to NAR's estimates, about 2.8 million homes short for current demand. And I'm telling you right now, emotions are high. People are upset about interest rates and all of this, but supply and demand will overrule emotion every time. This situation we had back here, we had too many homes and too few buyers. The situation we're in today is we have too few homes and too many buyers. Although a lot of those buyers are on the sideline due to affordability right now, when the rates come down, make no mistake, just because a buyer's on the sideline doesn't mean that they're out of the game. They're simply in waiting mode for rates to come down. And here's the interesting thing is construction is still missing the mark. This is the most recent, came out yesterday for April 2023. There were only 1.41 million construction permits pulled. New housing starts 1.4 million and completions only at 1.37. So we're not even gaining ground right now on the shortfall we have for available housing. We're actually losing ground on it. And you can see between the permits and completions, construction companies are still having issues actually getting these homes to completion. And existing homes, what is out there right now, they're moving fast. If you start to look at these numbers on a, yes, we're down 23% on a year-over-year basis. However, if you begin to look at the inventory numbers right now, We're at about 1 million units. It's up slightly from 980,000. This is again for April of 2023. We're only at a 2.9 supply, 2.9 months supply on market. It's an extremely tight market. I know a lot of people say 6 months is a normal supply. The actual number is 4.6 months. So we're still in a very tight inventory, but there's an acceleration going on. We're at 22 days average on market, which is down from 29 in March. Acceleration is happening right now in housing. 73% of homes sold in less than 30 days. That's up from 65% in March. And so we start diving into this. Now home prices are on the rise again. These are the 5 absolute gold standards in measuring home values. Case-Shiller in January, home values were down 0.2%. February, they're up. March, not out yet. FHFA, 0.2% to 0.4% increase. CoreLogic, negative 0.2% to 0.8% increase to 1.6% increase on a month-over-month basis. Black Knight, you can see the data here. We're going back into this market where inventory is going to remain extremely tight, and we're going to be in a situation where highest and best is going to be back. And buyers and sellers are emotional right now. And it's honestly more sellers, I think, for emotion right now than buyers. So I want to dive into why buyers and sellers are so emotional. There's some really interesting analytics that look deep into this. Right now, the personal savings rate in America is historically one of the lowest it's ever been. The rate we're at right now at about 5% savings, and this is of household income. So 5% of household incomes is being allocated to savings. There's only been 3 other times in traceable history that we've been this low on household savings. And it's interesting because you begin to see a normalized rate is about 10%. And again, if you extend this chart out, it averages about 10% of household savings. And you can see when the pandemic hit, lockdowns happened, and immediately savings went up, all-time high, almost 30% personal savings rate happened. Well, at the same time, people began to pay down their credit card balances. And so savings began to dwindle. And as things opened back up, people started spending money, but they also paid their credit card down. And you can see these 2 blips in the radar here. These are the 2 stimuluses that came out. First one came out, credit card balances came down a little bit. Second, bigger one came out, credit card balances hit another low. But then inflation starts hitting about here, and you can see the personal savings rates just fall off the map. But at the same time, credit card debt is now at an all-time high. We're nearing $1 trillion in credit card debt right now. And what's interesting is right here, the average credit card rate was 14%. Today, we're over 22% as the average credit card rate. So not only are people putting more on credit cards, have less in savings, but now their payments are being compounded much higher because the Fed keeps raising the federal funds rate. And we just saw another Fed member come out yesterday, say we may have to do additional rate hikes. We can't control what these people say. We think they're idiots. Trust me, I think they're all idiots. They've already raised it too far. I don't want to dive too deep into that. But then let's compound this. The average car payment in America is almost $800 now. That is doubled in 3 years. 1 out of 6 car payments is over $1,000 a month. And these terms are actually understated because 6-year auto terms are the most prevalent term for auto loans now. So now, not only are you taking auto loans at higher rates, but you're taking it for a longer term, and your payment has doubled in the last 3 years. Right now, there's a financial crisis happening for the average American family in this country. So buyers and sellers are emotional. We believe interest rates beginning with 5 handles, we will see them this year, whether it be 3rd quarter, whether it be 4th quarter. There's too many outside factors for us to dial in a date on it. But sellers have these things called golden handcuffs. 28% of all mortgages in America right now have an interest rate of 3% or lower. 72% of mortgages at 4% or lower. 97% of all home loans in America today have an interest rate of 6% or lower. But the good news is that 33% of homes in America are owned free and clear. So there is a whole portion of home sellers out there right now that don't have golden handcuffs of low interest rates on their homes. but we also have an equity boom in this country. The average loan to value is the lowest it's been in recordable history right now. Going back to 2008, there was an average of 19% equity in a home. 2011, 27%. 2013, it jumped to 38. 2016, 44. In 2022, there's an average of 58% equity in homes right now. According to Black Knight, the average tappable equity, now tappable meaning money that people could pull out, because when you do a cash out refinance on a home, you can't tap all of your equity. But the tappable equity in the average home in America right now is $185,000. We all know what a debt consolidation refinance is. I think it's time we talk about debt consolidation purchases. Debt consolidation refinance, people do a cash out refinance and they pay off their credit card debt and they take on a higher mortgage. But this same philosophy can be used on a purchase market. And I want to dive deep into this because this is going to be one of the keys going forward. So let's look at a scenario. A current homeowner has a home and they have a 3% interest rate on it. Let's say today's rate is at 6.5%. They bought this home 4 years ago for $500,000. They took a $400,000 loan. Based on appreciation, their estimated value today is at $696,000 for this home. They should have about $363,000 remaining on that balance for $333,000 in equity. Now, what your average seller is going to want to do right now is come out and say, well, I want to buy an $800,000 home. I'm going to take this $333,000 in equity. I'm going to put $300,000 down, pay my closing costs, have a little bit left over, and then they hit sticker shock and they say, whoa, my payment's going to go up $1,778 a month. Like, oh my gosh, I don't want to give up my 3% mortgage. But the seller likely has debt. And that's where we have to get really creative, and you have to be an advisor in this market. This is known as the seller's golden handcuffs right now. And if you don't think it's real, Forbes just wrote an entire article about it. So once, to me, like, these things come out as stigmas, people start to feel it. But when the news reports on it, you're going to have a whole nother segment of sellers that didn't know they had golden handcuffs that are like, oh yeah, I read that article and that's me. Like, oh yeah, like I'm not selling my home. So how are we going to combat this? Do they really have a 3%? That's the real question. We need to start looking at their other debts. So if you take this person who's got a $370,000 balance on their mortgage at 3%, but if they've got a $20,000 few credit cards, a $10,000 Discover, and they got a $50,000 HELOC, and they got higher interest rates on those, well, the blended rate of their debt is actually like 5.7 or 5.87%. So we began to look deeper than to saying, yeah, you got a 3% on your mortgage, but let's do a blended rate of all of your debt. Because there's another way we can look at this. So they come in to buy and they're like, well, I'm going to buy this home, but man, that sticker shock of $1,778 hurts. But they're putting so much money down, they're taking out a 56% loan to value on their new home. Why don't we look at this and structure it in a way where we can take all these monthly debts and say, hey, why don't we put a little bit less down on your home, pay your debts off, and now that new $800,000 home is going to cost you $235 a month more. And the most beautiful thing of this is, yes, you may not like the 6.5 or 6 3/4 interest rate you get on your home, but you can always refinance it if rates come down. And it is a fixed rate. Whereas your credit cards, if the Fed does what they keep talking about, your credit card debt's going to continue to increase every time the Fed raises the federal funds rate. So at least it locks it in so it will never go up again. If rates come down, you can always refinance. But these are the type of things that we're going to have to do going into this market to get creative, to work with sellers, to get them to understand that there's a bigger picture to view just outside of their 3% interest they have on their current mortgage. We've talked about sellers, but what about buyers? When we get into this market and inventory is extremely tight, we also have to get extremely creative on offers. So I want to talk about getting creative with offers. One thing that we've done extremely successful here at the Epic Mortgage team, because we average such a fast turn time, we can go in with an offer, 14-day closing, 10-day inspection period. We can waive the financing contingency and the appraisal contingency on that offer. We will rush the appraisal. It's going to cost the buyer about $500 extra, but that's really just an insurance policy to secure their binder. And what we end up with is we end up with an appraisal and an approval on the loan while they are still in the inspection period. So if for some reason that appraisal comes in low, or if for some reason there's an issue with their loan, which there shouldn't be, we average almost 99% clear to close on every pre-approval we do. There shouldn't be, but if there is, we have an ability to go back and negotiate. Working with a lender right now that's respected in the community is going to be so crucial. If you come into a tight market, I'll tell you just a brief story. So I have a client that is shopping in Atlanta right now, and they put an offer in. Property was listed at $475,000. We came in with a strong offer, $495, 14-day close, waive the appraisal contingency, waive the financing contingency. They lost out to a $575,000 all cash offer with no inspection, 14-day close, $100,000 over list price. If you don't think we're going back to that, we're going back to it. So working with a lender that is respected in the community is going to be key. One of the things that we do here at the Epic Mortgage team is we ask all of our agents, when you're putting an offer out for a mutual buyer, copy us on the offer. What we do as loan officers and loan originators is we will immediately respond with a video to the listing agent explaining the strength of the offer. And I think it's such a crucial piece of the puzzle. Nobody is in our market is doing these type of things. But what if you as a listing agent got a video message back and said, hey, I know you just got an offer for John Jones. I just wanted to take a second, introduce myself as the loan originator. I want you to know the buyer is salaried. We've got great credit scores. Even though the buyer's only putting down 10% on the offer, we have assets we could go to 30% if we need to. It just makes more financial sense for them to do 10%. We've got the bank statements, pay stubs, W-2s, everything's reviewed. We have automated underwriting approval, and we're going to close this thing in 14 days. Those are the things that we're doing to help your clients get the offer accepted. I want to talk about appraisal gaps, because we're going to get back into that. And it's not something I'm going to be super happy and loving. Nobody in the lending industry really loves appraisal issues. But we've had a declining home value market. I know in some areas less than others, but we have for a bit now. And now as values begin to go back up, there's going to be closed comps for lower values. So I want to talk about appraisal gaps. It's one of the biggest misconceptions that when you have a buyer that they're putting, in this scenario, it's a $500,000 purchase price, they're putting 20% down, and the appraisal comes in $50,000 low. We don't expect that to happen, but that's a 10% low appraisal. What do we do in that scenario? Does the buyer need to bring $50,000 to closing? No, they don't. There's options we can look at. I know nobody likes to pay monthly PMI, but in this scenario, they had an 80% loan to value. Their cash to close doesn't change by changing it to an 88% loan to value. Only thing that adds is a $50 a month increase in their monthly payment for PMI. So it doesn't necessarily mean the end of the world. Now, this is a case-by-case basis, because if you have a buyer that's putting the minimum down, they're putting 3% down on a conventional loan, well, then they have to bring the difference. But if you have buyers putting a 20% down payment, appraisal gaps aren't that big of a deal. There's another option you can do of financing the PMI. Some buyers are really, they don't want monthly PMI. Well, there's something called a single premium PMI that you can buy out the total cost of the PMI, and you can roll that into the loan. They don't even pay it at closing. So in this scenario, $600,000 purchase price, appraisal comes in at $580. To buy out the PMI is $2,016, and this is at a 740 FICO, 20% down buyer. This, in all transparency, $2,016 to buy that PMI out. You can roll that into the loan, and their payment changes $13 a month for a $20,000 low appraisal. On a $40,000 low appraisal, their payment changes $28 a month. They could also pay these dollar amounts out at closing and just increase their cash to close and not have it roll into the loan. There's all sorts of options we can do on this. Another thing I want to talk about on appraisal gap creativity is how you present an offer. It's very important for buyers agents to understand in this market. when you have a buyer that is putting a large amount down on on a property, it may be better to change up your offer a little bit. Look at these three offers. The net for the buyer is the same, $120,000 on each one, but put yourself in the shoes of a listing agent. What is more attractive? Offer A, they're doing a 20% down payment with no appraisal gap. Option B, they're doing a 10%, or they're doing a 15% down payment, but they're offering a $30,000 appraisal gap on it. Or you could come in at offer C and say, hey, we're going to do a 10% down payment, but we're willing to cover up to a $60,000 appraisal gap. So if you have buyers out there right now that are putting 20, 30, 40% down, maybe consider restructuring that offer from a 30% down to a 20% down with a 10% appraisal gap contingency on it. The net to the buyer is exactly the same, but talk about increasing the strength of your offer by putting an appraisal gap in there. And it doesn't change anything on the buyer side. One of the last things I want to talk about here is FHA. I have done extensive coverage on this, and I will not vent my frustration, but FHFA, not FHA, FHFA, which governs conventional loans, has made some idiotic moves to increase fees for credits, good credit score buyers on conventional loans. I'm sure you all have seen the news, and there's a lot of misinformation out there, but yes, fees have gone higher on it. And so we're going to see FHA be much more predominant in this market. And I would ask listing agents on this call, be cognizant of FHA right now. If you've got a property that isn't a dilapidated property, reach out to your loan officer, reach out to the loan officer on an offer and ask them about the FHA offer. Because a lot of times it's simply a conventional buyer that it makes more sense for them to go FHA. Like in this particular scenario, this is a 700 credit score FICO buyer. They're going to save $173 a month in just monthly payment, plus almost $6,000 less cash to close. And this loan would be approved on either one. So we're going to see FHA become more predominant. And if you have loan officers that won't answer these questions for you, maybe consider a new loan partner, because your loan officer should be reaching out and saying, hey, we've got an offer coming in. I know it's coming in as FHA, but this buyer is absolutely approved conventional. It just makes more financial sense for them. We've looked at the property. We don't see any issues why this property won't go FHA. So we really like you to consider our offer. FHA is going to become more predominant simply because of the idiotic moves that the administration has done in changing fee structure. In conclusion on this, things are going to get better. It's going to take time. There's so many outside impacts and people talking and Fed members who have press conferences that these guys, they're dumber than boxes of rocks, I swear. Inventory issues are going to abound. We're going to be back to multiple offers. It's time to get creative. Getting creative with sellers to get rid of their golden handcuffs. Working with advisors. I don't like to, if you look at my website, we label ourselves as mortgage advisors, not loan officers, because we have to be advisors in this market. Sellers' golden handcuffs are going to be the biggest thing. My team and I, we'd be willing to go on listing presentations with you, meet with your sellers, sit down with them, look at all their financials, and explain to them why selling their home may be an advantageous move by wiping out other debts for them. We'll go to the ends of the world to make sure that you can get your job done. So who is the Epic Mortgage team? We're local to Jacksonville, Destin, Fort Lauderdale, Orlando, also in Fayetteville, Arkansas. We have an average clear to close of under 12 days. It's shocking. That's every product. Yes, even non-QMs are mixed into that. We rock deals to the finish table. We have the highest NPS score in the industry. NPS is Net Promoter Score. It's a single question survey that is sent to every buyer. On a scale of 1 to 100, how likely are you to recommend the Epic Mortgage team? We're coming in at 95. We have the ability to shop more than 25 lenders. We can do out-of-the-box financing. Yes, it's not everybody's favorite deals. Mobile homes, single-wide mobile homes, condo hotels, non-QM deals, bank statement loans, debt service coverage ratio loans. We have it. Here's a nice view of the team. In Jacksonville, we've got 7, about to be 8, 1 not yet announced, so I'm not putting him on the board yet. We've got two mortgage advisors set up in Fort Lauderdale, 2 in Orlando, Jed and I out in the Destin market, and Miss Kayla out in Arkansas. Before we get to Q&A, I want to do 2 quick invites. if you have your phone on you, pull your phone up because I'm going to have a couple of QR codes on the screen. First and foremost, Barry Habib. If you don't know who this guy is, you need to know who this guy is. He has been my mentor in understanding how the housing market works. I had a 30-minute meeting with him yesterday, and he revamped my entire slideshow for today. It's a blast. So I was up all night. But Barry is going to be live in person in Florida. People travel from all over the world to come see this guy. It's a free event in Palm Beach, May 25th, next Thursday, 3 p.m. to 6 p.m. If you're interested in attending, scan the QR code, register. I would love to see you there. This is not an event that is going to be a waste of time. The guy brings so much value. Every single time you see him, it'll blow your mind. And the last piece I want to invite you to is I have a personal Facebook group that is set up. It's exclusive for real estate agents. We don't market in this group. We don't sell in this group. The only other loan originators in this group are people on my team. We're there to answer questions. We're there to help and provide you the most up-to-date housing data information. Sometimes that's on a weekly basis. Sometimes it's on a daily basis. If you'd like to be a part of the Facebook group, scan that QR code, hop into the group. We'll get everybody accepted after this call. We'd love to have you there and share the most pertinent housing information with you. With that, I'm going to stop sharing screen. Thank you for attending. We're going to go to Q&A and see if we got any questions that I can hop on here and answer.
So far, we have only one question, and it's, will there be a recording of this available? And the answer is yes, there will be a recording available. We do plan to send it out to all the attendees, as well as a few people who couldn't make it that I know wanted to be on here. So yes, there will be a recording. And if you have any more questions, please put them in the questions box, and I will ask Andrew, and he will answer. And while we wait on that, actually, there were some really good things that you said, and I took some notes. Biggest thing for me, huge key takeaways, is just getting creative, working with sellers on the bigger picture, not just selling their house, moving to the next one, looking at their direct mortgage they have, but overall looking at their entire portfolio, their entire financial picture, being more than just a order taker, really advising them on their loans. So that's what we're here to do. I love that, and working together with our realtor partners to make that happen. So we want to team up with you and do that. And I also loved what you said about appraisal gaps, Andrew. So much misconception in the market, in the industry over that, with realtors and also sellers and buyers. Well, not really sellers, but buyers. So I love that. A couple questions are coming in now. So as we all know, you guys in the mortgage industry are basically the devil buyers. What tools does UMortgage offer to us agents to give to buyers to help us get them to team up with you? So what tools does UMortgage offer?
Oh man, yeah. So no, yes, you're dead right. Everyone wants a home. Nobody wants the debt that goes with it. So yes, we are the devil to home buyers. That's just how it works. Everybody loves the white picket fence. Nobody loves taking on 30 years of debt. So what tools do we offer? You name it, we can come up with it. We're outside of the box thinkers. If you need marketing pieces, if you need advertising, whatever you need, we're going to be there to support you on it. You want to do home buyer seminars, bring them in. We'll have a loan officer meet up with you. We'll do a home buyer seminar. Like, we're not above anything here. If you guys, I'm going back across the state from back to Jacksonville in a week and a half to host an evening home buyer seminar. Like, these are the type of things we do. Whatever you need, we're going to be there for you on it.
Yep. Another question. Doesn't someone who has been approved for a conventional loan versus an FHA look better to the seller's eyes?
It does. Conventional loans do look better to the seller's eyes, 100%. However, there's going to be a lot of cases, and trust me, it drives me insane, but there's going to be a lot of cases where financially it makes so much more sense for clients to go, and these are good qualified 700, 720 credit score buyers that financially makes so much more sense to go to FHA. And unfortunately, I know what this market's going to do. We're going to have to drive people into worse financial situations to get an offer accepted, which is why I wanted to put it on there. If there's listing agents on this call, be cognizant that there are going to be FHA offers. And an FHA loan is going to close just as fast, just as easy as your average conventional loan, unless you're dealing with a really dilapidated, outdated, problematic property. If you've got a run-of-the-mill property, you're not going to have any issues going FHA over conventional.
All right. Another question about our marketing material. So another realtor, Kim Smith, wants to know about our marketing dashboard, if we have anything available that we can help create.
I don't necessarily have like a dashboard, but we can most certainly get Kimberly over a ton of marketing pieces that we can co-brand, that we can brand with her information. We're all about it. Whatever you need, hit us up and we're ready to go.
Yeah, we also do things like list reports, other things that we subscribe to, Rate Plug, that can help you with some of your advertising too. So besides above and beyond your mortgage, there's things that we are subscribed to help you.
Yes.
Let's see. I'm trying to go sort through all these questions. They're all coming in at once, so bear with me. Do you have a best guess on when the shift toward a strong seller's market will happen? Do you have a crystal ball, Andrew?
Now, I mean, the reality is as when interest rates begin to come down, that's the reality of it. We don't know when that's going to happen. There's so many outside factors, but I would think if we see inflation hit the charts we think they're going to hit, of being about 3.5% on core inflation by July, mortgage rates will have to follow suit at some point. The moment rates come down, buyers are going to flood back to the market. Sellers are much more emotional about their 3% rate than a buyer is about taking on a 5, because now buyers have gotten used to this high 6s, low 7s. This has been a normal thing now for a long time. So they start to see 5s, buyers are going to flood the market. We will shift immediately to a strong seller's market.
A couple more questions. Do we have partnerships with listing agents, something that could benefit our sellers and attract buyers to the home?
So, I mean, I don't necessarily know the exact idea behind the question, but I'm more than willing to partner with listing agents. I mean, if you need open house flyers, if you need marketing pieces, so through MBS Highway, which is Barry Habib's company that he's going to be live in West Palm Beach. His company, we have open house flyers. We have, market reports specific to a zip code that we can print out and have ready for open houses. Like we have all sorts of tools at our disposal for you.
Awesome. And then would love a marketing piece to include in listing presentations outlining the idea behind the debt consolidation purchase. So I'm sure we could get some marketing information out about that and some examples. And we have debt consolidation calculators that we can show each borrower situation is different. Everyone's situation is unique, but absolutely.
Yeah, and the whole debt consolidation for sellers is a conversation that Barry and I had yesterday afternoon, and it just blew my mind. And so yes, I will be getting with our marketing team, and I will be getting marketing pieces put together specifically for this, because I do believe this is going to be what we need to do to get sellers to give up on holding that stigma of their stupid low interest rate.
Yeah. What's the difference between an appraisal on FHA versus conventional and a VA?
So here's the interesting thing is all three of those products on a value wise are within 0.2% of each other at coming in on value. So there's these stigmas that VA loans appraise lower than other ones. No, they're actually 0.1% lower on average than conventional, 0.1%. FHA right in the same range, USDA right in the same range. They all appraise out about the same. You definitely have a little bit tighter MPR, minimum property requirements, for government-backed loans. So if you have a property that is dilapidated, if you have a property that's got, cracked windows, they look more at safety and health hazards. Is there a safety and a health hazard? Whereas FHA, VA, they're going to go a little bit more deep into it, especially your homes that were built prior to the lead-based paint stuff. If there's chipping or peeling paint and it's an older home, you could run into issues with that. So I'm not saying FHA is or VA is for every property, but I am saying if you've got a relatively good newer property, you're not going to have an issue with it. the amount of times we have issues come up on VA and FHA appraisals, unless it's a really poor property, is extremely low.
Yep. Do you offer hometown heroes?
Yes, we have a whole team set up specifically for hometown heroes. So yes, we do offer hometown heroes, and we can rock those to the finish line.
And last question, Kimberly's already left, but do we do land as well?
So we have outlets for it, but I'll be honest and say they're not always the best outlets. Land is traditionally done best through your local credit union. They just are. I'm not going to sit here and try and sell every single person on us on every product. We nail out residential mortgages on a massive scale. Land, we have a product that can do it, and we'd be more than happy to price it out, but it's not exactly the bread and butter of the business. But I think that's it. I don't see any more questions coming in. So I want to thank everybody for coming in today. I know I talked and rambled a lot. Hopefully I brought a little bit of value. I feel like I need a drink of water after all of that.
Yep, you did great. I think this was very informative for everyone. I've got a few people commenting, thank you. So any other people have any additional questions, you have our email addresses, because I know you were invited on the call, or you have us on Facebook or any of our social media outlets. Get in touch with us and let us know. We're here to help you.
Awesome. I appreciate you guys. Take care.
Thank you.